Yep. Hello. Good evening, everyone. Right now, 7 p.m. Malaysia time. Today,
Evening.
yeah, it's evening time. Okay. Today, we are actually so proud that we can welcome Puria, who is the open source developer signed up previously working on
So
Steam.
proud
Today is the
that we come.
Ask Me Anything session about DeFi. But before that, Puria, can you just introduce yourself to our friends here who are watching live?
Yes, sure. Thank you very much for having me. I'm Puria. I'm working in this space for around, I think, 4 to 5 years. And I started learning about crypto by working full time for a company called Steam. If you know about it, it's another blockchain called Steam. So it's a social network with a native token called Steam and SPD. So I was working full time as the open source developer for their next gen social network called BZ, and it was mind blowing the first time I learned about crypto and every possibilities that this industry is creating.
Mm.
So after that, I didn't work professionally in this field anymore because I moved back into my own. My background is in more full stack web development and user facing applications. So I was working in that field again, but crypto was always like a hobby for me. I was studying, experimenting with different chains. After that, I learned about Monero and about Bitcoin Cash, and a bit about Ethereum.
I see.
And so I was working, and in the past 1.5 years, I'm just working in the side on Bitcoin Cash. I developed a DApp wallet, which is a wallet that can have interaction with decentralized applications for Bitcoin Cash. And regarding DeFi, I'm also just observing the scene, the things that are happening in the background. I think it's very interesting and very exciting because given the fact that I'm here, let's say for the last uh, 5 years, I could see that how like the phases that like the problems that was created and the issues that we had and that lead into applications on DeFi to be created. And some people call it a hype. It's like just a trend, like there was ICOs and now we have DeFi. And but I think we had a genuine problem before that wasn't being solved with all the previous ones. And the reason DeFi is hyping these days is because it's fixing many of those problems that we used to have. So yeah, it's great talking to you guys about it today. Yeah, I'm excited.
So
So
thanks,
thanks,
Puria.
Puria.
That we really appreciate the time for tonight. Okay, so the topic
Sorry,
as we
Anderson. I
mentioned,
think I think there's an echo on your side.
echo,
Yeah.
echo from my side. Where the
Yeah.
media?
Probably you're opening the YouTube and Facebook as well. So you should close.
No, I don't turn on any.
All right. No worries then. Just continue.
Is it okay now?
Yeah, it's okay.
Yeah.
Okay, right.
Yeah.
Okay, okay, okay. So today we'll be discussing about DeFi, right? As so Korea also they mentioned a little bit of DeFi. So what is DeFi? Right? DeFi actually is a decentralized financial. Okay, it has been seriously a hot topic this year alone in 2020. There's a lot of projects coming out. Uniswap, the Year Finance. People all hype about it. Okay, and today we will learn something about DeFi from Puria. So Priya, can you actually explain to us again actually what is the exact definition of DeFi? What do you think about this?
Yeah, well, DeFi stands for decentralized finance. So it's a broad category of financial applications. The ones that I think we are talking about today are mostly in two categories. One of them is like in the category of lending and borrowing, and another one is in decentralized exchanges. That's the most popular ones today, but it's a broad category. So how this term DeFi is coined, I think there is a history for it, but people are working on some of the early applications of decentralized finance in Ethereum. They knew that they were working on something, but there wasn't any term for it. So there was actually people who worked to coin this term and make it something that is in contrast with CeFi, which is centralized finance or traditional finance. So the difference between these two is that in centralized finance, we had trusted third parties who were in charge of providing the financial instruments that people would use to trade or to do any sorts of financial activity that would be profitable for them. So that's important, that the financial activity should be profitable. There should be value generated from that activity. Otherwise, no one would do it, right? So those activities in CeFi, there was always trusted parties. So trusted parties, they are working similar to banks. Most of the time, they are actual banks, but they could be, for example, companies that are working under regulatory bodies, and they have licenses to do this kind of activities. But the problems that exist in those systems is that, first of all, a huge amount of profits in the system is going to the central party, because they have their licenses, they have everything, they have the trust. So they are taking away all the fees, they are taking away all the extra profits. And also another issue that was available in those central activities is that they are not available for everyone in the world. There is no open, accessible environment that anyone from any country, from any geographic location, from any age, any race could participate. Why? Because that's how regulation works. They have to follow the laws and rules of the country that those businesses are operating in it. So all these problems exist before, and in decentralized finance is providing an open, accessible environment in a trust minimizing environment that we don't need to trust that the money that we are depositing into the system, we don't need to trust it to any other person. Why? Because the reason behind it is that DeFi is working under blockchain and smart contracts. So first we need to understand what are these two. Many of the people listening to this probably they know what is a blockchain. So blockchain is a wide network that is distributed. It is decentralized and does not require any single party to come up with a decision regarding some transactions. So people can do transactions in a network without actually requiring any permission. So a blockchain by nature is censorship resistant. And what is a smart contract? A smart contract is basically a code on top of the blockchain. So when we put this code on top of the blockchain, this code has all the characteristics that the blockchain has. It's still censorship resistant. It's still accessible to everyone, and it's open, and it's minimizing the trust. So instead of trusting you to send your money to a central organization and hoping that they would give the money back to you with interest, you are trusting. If there is still some trust in it, you're trusting the code is written by the developer on the blockchain doesn't have any bugs, it doesn't have any security issues, doesn't have any admin keys that they can steal your money. So there are still problems in the system as well, but the trust is minimized in a sense that if the smart contract is supposed to work properly, your money doesn't require any permission from any third party to be withdrawn back to you with interest and with all the gains that you're supposed to have.
Interesting. Yeah. So basically, DeFi gives you an openness to access, so people don't need to do KYC in order to access the product, and there will be less fee or no fee at all because there's no middle third party in it. But as you mentioned, basically, not anyone, but a lot of people can create DeFi protocol. And as you mentioned right now, there's still some risk involved in terms of how people can identify which protocol is actually safe and which one is, a little bit risky. So how do you identify these protocols in general? Like how safe is it, and which protocol that we should choose, etc.
Yeah, that's a good question. In this space is a space is attractive to investors because there are more returns on their money that they are putting with the current rates. So it means that there is more profit in this space. When there is more profit, it means that there are more risks as well.
Exactly.
Compared to previous solutions that wasn't much profitable these days, but it was probably easier to access by traditional investors, and it was like easier to trust. So how do we trust in these codes that we call smart contracts, and we are putting them on the blockchain? There are processes called auditing. So the auditing of smart contracts is done by well-known companies, well-known security companies in this space. So most of the current popular protocols that are being used, these smart contracts, they're already audited by many of these companies. So it's something that investors should research on it. They should research that if the contract is well audited, if there are well-known people in the space that they endorse these contracts, and they have to look into the volume as well, like how many other investors already put their money in it, because it's a transparent space. You can see and verify exactly. They can't lie to you about the numbers. You can verify the numbers by yourself in any block explorer, like others can, for example. So you have to check the volume of how much other investors are also putting money into it. And there is a thing that many people, when there is a new contract or there is new DeFi application, many investors, they don't put their money immediately. They wait and see how it's gonna work out. But I can say that the popular ones that are here, they're working for more than 2 years, I think. Some protocol like Uniswap, Compound, and the smart, everything is open. Billions of dollars are in there, and if there was any problems, because the code is open source, we should have known by now.
Yeah.
There are a lot of hackers, there are a lot of people who want to
yeah,
take advantage
yeah.
of all the money in this space. So probably it's kind of safe to trust, but there's always new problems, of course.
I see. Yeah, makes sense. Yeah, in that sense, that do you think that everyone should access DeFi, or do you think as of right now, DeFi is still mostly intended to people that is like more well versed in the crypto world? Like for example, should I tell my mother or my grandmother to try DeFi, or do you think that's still too risky for the
Yeah.
ordinary people?
Just
Yeah,
any common people.
yeah. Do you think DeFi is
Yes.
for everyone, basically?
Uh, well, it's surely uh, it's not for everyone right now because the user
Mhm.
interface and everything is
Yeah,
quite confusing. Even for me, it's confusing in many of the applications. Like,
yeah.
why it's so dark? Why it's so so it's like, but how accessible it is, I think it's what is important for me personally is that, and I still don't see it completely happening in this space, is that for every $1, you should have the same opportunity than
Mm,
someone else has, let's say, with hundreds of thousands of dollars, right? So you should have the same opportunity value per dollar.
Correct.
If someone has more money, shouldn't have more opportunities than you have. So we still don't see it completely happening in Ethereum because of the high fees. So that's one of the problems. But about if should normal people use it, it's just if they have enough support, they have enough help. I think they can at least put in 5%, 10% of their money, but
mm,
people putting their lives, their life savings or things like
okay.
that in DeFi, it's not a wise choice at all. I'm sure people in this space they're also not doing it. People who it's their job to work on DeFi, they're not doing that kind of decisions. But yeah, it's pretty much. I mean, and that's not my expertise to give
Mm,
investment advice, but the way that I see it is that it's good that everyone has some at least understanding about these opportunities, because it's the way that we see the trends is that it's gonna keep getting better and better and provides more financial opportunities. And so there's going to be a moment that is too late to learn. So learning is more important than putting your money in the first place.
See. Talking about this DeFi, right? Since that you're saying that everyone also can actually have the access, but who do you think will actually benefit the most from this DeFi? Is it those like big corporates, like giant companies, or maybe any e-commerce sector? Can they actually benefit from this decentralized financial?
Uh, the corporates and I mean those companies you mentioned, it's a tricky question because you should see what's uh, the situation with the company, and if they have extra cash flow and they want to put it in a safe interest earning let's say contract, they can do it because DeFi is providing the one of the highest returns, I think, for stable coins. Like for example,
mm,
there are companies that probably they are not interested in holding Ether uh, or Bitcoin because of the risks involved, but they might have access to cash flow in USD, US dollar, and so if they would know that they can earn up to 24% APY per year, so they're like, okay, that's a great deal.
yeah.
They can never get it anywhere else.
Yeah.
What are the restrictions in those companies and in these corporations that can they actually convert their money into stable coins in crypto? Some of them maybe still they can't, but probably we are going to see that they are going to move into this space because of all the opportunities available. And I think the risk on the stable coins interest earning is quite lower than any other areas of DeFi, because all the contracts, they're all designed in a way that they give the most assurance to these part of the deal. The lenders, not the borrowers, the lenders. So yeah, I think there are hopes that those individuals would also be able to or people with I think that's how it is at the moment, that people with a larger sum of money, like more than $100,000, they are taking the most benefits out of these opportunities. But hopefully we will see that even the a smallest amount of money, like $10 would give you some benefits, but we don't have it at the moment.
Okay. Moving to the next question, right? This is also part of DeFi, as you know, what we call it liquidity pool. Yeah, so I think it's part of the system that's important.
Mm-hmm.
So can you actually explain a little bit about this liquidity pool? What does it enable us to do?
Yeah. So liquidity pools are very interesting. The way that we have to say is that in DeFi, as we talk about it, there are different categories. One of them is decentralized exchanges. So decentralized exchanges means places that you can exchange different money to each other. Like in this context, they're all crypto. So these cryptos, you're doing it, but there is no central party or central exchange like Coinbase or Binance to facilitate the trade. So it's a smart contract that's doing it. And we have two categories of these decentralized exchanges. One of the categories are they're order book based. Order book based is the one that any trader is familiar with. Is that there are two order books, like buys and sells, and then people would just send their offers there. So the market is the price for the market is decided by individuals putting their orders and competing to make the trade happen. Can you hear me?
Yes, yes, you can hear.
Yeah. Is it okay? Yeah, because.
Yeah, we can continue.
Okay, so.
Hello. Sorry, I cannot. Seems like Puria is freezing, like glitching on my. Is it just me?
Oh no, it's okay.
I don't know.
Sorry, it's my issue then.
I was freezing before, Anderson.
No, it's okay. I can see.
It was okay. I think it's Zaki had the issue. Okay. So yeah, so we have like these two type of decentralized exchanges. One of them is the order book based, and the other one is liquidity pool based, which is a new type of exchange. So what is liquidity pool? Liquidity pool is a smart contract that people are depositing their money into the smart contract. You okay, Zaki?
Yeah. Sorry.
Okay.
That's my issue. Yeah. Right.
Okay. Good. So these liquidity pools are pools, or just basically smart contracts that people are depositing their money in it. But the money they are depositing, it's supposed to be a liquidity. So a liquidity means that you're for a specific pair. So let's say a pair of ETH to DAI. DAI is a stable coin, ETH is Ethereum. So you want to provide liquidity for this pool, you have to provide an equal amount of equal amount of value to both of these. So some of these pools, they have different rules. For example, Balancer allows you to have like different ratio. But for example, in Uniswap, you should have the equal ratio, but you have to provide both of them. So when you as a liquidity provider provide both of them, you are the one earning all the fees instead of the order book specs, which usually developers are earning the fees, or centralized exchanges that the exchange is earning the fees. In this concept of liquidity pool, the liquidity provider is earning the fees. So that's the definition of a liquidity pool, that it's created first time, I think, with Uniswap. But they had ideas from MakerDAO back in 2015, which had like the first application of DeFi is created because it's also into. Can we also go back about before, like how we have because it's very interesting. This whole space, the DeFi space, is providing a few elements, like for example, governance tokens. Governance tokens or governance protocol. We didn't have something like this before, or the more advanced smart contracts. So how this is created? If you were around in 2015 or 2016, that there was like the ICO boom. Like everyone is creating ICO. So some people might not be there. So it was so easy that everyone would just create an app, any kind of app. You don't need to have any reason to be on the blockchain. They create their own token and be like, okay, we're gonna accept this token. This is a token. So buy the token, and you have a share of the company. And this is a new decentralized finance, decentralized whatever. It's like a stock. And there was like, oh, okay, this idea is really great. You can have a portion of that company without going through the financial system. But turned out that financial system was there for a reason, because it is obligating companies to work on their stocks or work on what they have. Exactly. But these tokens had no correlation with all the values that's in their company. So they could raise millions of dollars on a ERC20 token, and they just stopped using that token. And they had everything. They had their staff, they had their company, they had all the money that they raised, and token holders had no value. So that's what's difference. That's what different in DeFi today is that we understood that these token holders are supposed to have power in the system. We can't just create tokens. That token by itself has no value. So that's why these days governance tokens with these protocols are always something that are going alongside. So most of these protocols, like for example Uniswap, uni holders, they have votes in the governance. They can vote on the governance of the protocol, and these votes are applied directly in the protocol level. So they can make changes in the protocol. And all these different DeFi applications, the power is in the token itself. So if you have the token, you own part of whatever there is that is creating value, that's generating value. People working on it, developers, they have no power. They can just move. There is no value in whatever they are doing without the protocol or contract. So Yeah, I think it's very important that we mention like all these events that lead to this place, and the MakerDAO, I think, was one of the first in 2015 that introduced this concept that a smart contract could be much more than this. And it was basically just for you to deposit some ETH and you can mint some DAI, which is supposed to be, it's a stable coin, but contrary to other stable coins, it's algorithmic. So there is no real US dollar deposited anywhere that's supposed to back this up, that is kind of centralized, which is the case with USDC and USDT. So with DAI, you could just deposit the money and mint the stable coins that you might need to deposit it in the pools or do any kind of financial activity with it, because it's stable, so there is intrinsic value in it. And yeah, I think that's a very important part of the history, that people realize that, okay, now that we can do this, so we can bring it to different categories, like we can bring it to the lending and borrowing, which is basically the same concept that MakerDAO had, but only for one pair. One pair, they're going to have it for everything. So they call it like a loan, but it's not actually a loan if you think about it. It's basically a CDP. It's a collateralized debt position. So you're collateralizing your crypto. Like you have some asset that you're thinking that's gonna gain in value, like Ether, and you're collateralizing it, and you're getting a different money, because it's a money market, so you can get anything you want. So it's very similar to a margin trade, but you're getting your tokens, and you can bring it to any source of financial activity, do anything you want with it, and you just have to repay the money that you take. Otherwise, you will be liquidated.
Yeah, interesting.
Yeah.
All right. Perhaps going back a little bit to the liquidity pool. So, for example, if I want to provide liquidity and I want to get an sort of an interest from it, so where do I send it to actually? Because we know that there's no someone or third party behind it. We know that we're sending it to a smart contract basically, but is there any risk involved with it? Like, how do we certain that our funds are safe? If the smart contract itself is actually safe and there's no malicious intent from the developer that built the smart contract itself.
Mm-hmm. So I think we have a lot of liquidity pools in Ethereum at the moment. I'm not familiar with all of them, but the popular ones are Uniswap, it's Balancer, we have Bunker, and I think we have Curve. So if you are an investor and you want to put your money in there, it's better that you study that what are, because each of them have their own trade-offs. So let's say, for example, in case of Uniswap, you have to provide equal amount of liquidity on the asset that you want to provide liquidity on. So let's say you want to provide liquidity on Ether and DAI, which is a stable coin with Ether. So you need to have equal amount of them, and you provide it in the pool section in Uniswap. So what are the risks? Yes, there are risks involved. The most important risk is, I mean, there are other risks as well, smart contract bugs or things like that. But I said the probability of that happening is much lower these days, because smart contracts are being used for a while now. But what is a practical risk involved is called a concept called impermanent loss. It's called impermanent loss for a reason, because you first we need to understand how liquidity pool work to determine the price, because we talked about it before. We have order book based
Okay.
the DEXs or decentralized exchanges. They have the order book, so there are traders who determine the price, right? But we don't have anything like that in liquidity pool. Liquidity pools have something called a product market maker. So what is a product market maker? It's an algorithm designed to make sure that price is going to be adjusted according to the free market or according to the supply and demand. So basically, if the value in both sides of a pair is not equal, the algorithm is going to increase the value, increase basically the price for the part that is not equal, to make sure that it's going to be always equal at the same time. So who's taking that money? Arbitragers. Who are arbitragers? So arbitragers are traders outside this platform. So let's say Ethereum price is in 500 in Uniswap, and in Binance the price is rising to 550. So what's going to happen? There are going to be traders who realize that Ethereum in Uniswap is cheaper. So they're going to buy the Ether from Uniswap and sell it in Binance for a profit, because there's opportunity to profit. So that's how Uniswap price is going to be matched. People will start buying Ether, and the product market maker is going to automatically adjust the price gradually until it reaches the equilibrium, that is 550 equal to Binance. So there is no central party who determines the price. It's just supply and demand. So this is great. This is amazing. But someone has to lose money, and the people who are losing money here, because arbitrage is making money, someone has to lose money. So that's liquidity providers. So when a scenario like this happens, we say that the liquidity provider had impermanent loss. So means if they didn't put their money in the liquidity pool and they kept their Ether and DAI in the first place, they would have more money now than they have at the moment, because the arbitrager made some money here. So first of all, if the LP or liquidity provider withdraw the money from the pool at this moment, impermanent loss turns into permanent loss. They lost it. They can never get it back. However, if they wait and Ether price come back to 500 again, impermanent loss is gone. They're going to have exactly the same amount of asset that they had before, plus the fees. So a question is that why would they do that? Why would people want to put their money as a liquidity provider when there are risks like this? So first of all, they are earning fees, all the fees that are on the trade. So when you put your money in a liquidity pool, you own some tokens that shows how many percentage of that liquidity pool you own. According to that, your percentage, you're getting all the fees in that liquidity pool. So that's a good thing. So you might be able, okay, the fees are higher than the losses that you caused by impermanent loss, but it's a risk. Sometimes it's higher, sometimes it's not. That's why some of these protocols, they introduce extra incentives for people to put their money in the liquidity pools. One of the incentives are, for example, yield farming. That's an extra token that is introduced for people who put their money there, and they're going to be rewarded with that token as well. For example, in case of Uniswap, it's Uni token. But other protocols, they also have, for example, we have Sushi Swap. They have Sushi tokens, which I think is the first LP that introduced this concept. They basically forked Uniswap, and they just added an extra token to it to attract all the LPs over there. But yeah, I think most of the time they make more profit, but there are also risks like this involved, that they're not going to lose all their money, of course, but they're going to lose a certain, they might have some losses in the process as well.
Makes sense. Right.
Okay, talking about this yield farming in Korea, how does it actually work, right? How is it profitable?
Mm-hmm.
Can it be more profitable than doing this regular trading, like let's say in the finance, we do the spot trading, we all this kind of thing. Can you explain a little bit about this?
Yeah, so when you're doing trading, it's a different process. It's a different activity. Trading is an activity that you are doing it in a daily basis. You have to pay attention to the price. You have to pay attention to the charts. You have to make good decisions. You can make bad decisions, and there are losses that no one else is responsible for. But yield farming is a passive activity. It's the activity of putting your money there for the contracts. So contracts would use your money for their own activities because they need liquidity, and they're going to reward you with some money, with some passive money at the same time. So it's not only the concept of yield farming, which is basically a reward token. To put it simply, it's a reward token. It's paid to many different applications of DeFi. It's not only for exchanges like liquidity pools. It's also, for example, protocols like Compound. They have comp tokens that are providing it as an incentive to people using it. Or I think other protocol, I think Aave also has its own. I'm not sure about it. Or LPs, I think Curve and Uniswap and many other, they have their own tokens. So it's a very difficult process if you have to learn all these things, and because the price of the token, the price of the reward token is changing in the market, your APY or annual percentage yield is also changing. So it's not a fixed percentage that you know that, okay, if I put my money, I'm going to make this amount in the end of the year. It keeps changing. So there are applications made that pool all the monies together, and they try to find the most profitable farm at the moment and do the farming there. So it's a different type of applications that are just created for the purpose that people don't have time to learn all these things or keep track of the price or anything. So we make it simpler. People can just put their money there, and it's the contract job, it's the pool job to go and find the most profitable place to farm, and they're just going to get their money. They're just going to get their rewards back, which is probably the highest in the market. which is, I think, Yarn Finance and Harvest are two examples, if I'm not wrong. Yeah, they're basically hedge funds, but in a decentralized manner, like in a censorship-resistant manner. That is, verifiable hedge fund that you exactly know what they're going to do with your money, and they're going to tell you exactly how much return they estimate that you're going to have. Yeah, so it's quite interesting and useful for people who don't have the time. They just have some money, so they want to send to these contracts, and they want to expect something back.
Yeah, so Korea. So we have learned about what is DeFi, liquidity pool, also yield farming. And for right now, can you actually show us a little bit of demo, like how does this liquidity pool, how it works actually? Or maybe JK, do you still have any other question for Korea?
No, I think we can just jump straight into the demo. Yeah.
Yeah, okay.
All right. So okay, I think we talked about before that I'm gonna show Uniswap. So I'm gonna share my screen.
Yeah, Zaki. So
Okay.
once
Let
you,
me let me know if
Yep.
you see my screen.
Yep, we can say it.
uh,
Okay,
okay,
so this is the
the
interface for Uniswap. So everyone can visit this address. You can just go to app.uniswap.org. And so this is the address for Uniswap, which is just a trading platform for Ethereum.
okay,
So I'm demonstrating here using testnet. And let's say we want to create a liquidity pool. So if you don't have MetaMask, you need to install MetaMask as well. You can Google MetaMask, and it's a browser extension that is going to be a wallet for you. So as you can see, I have 7 Ether right now, but it's a testnet Ether. So if you're working, your default option should be on mainnet, which is the real Ethereum network. But I'm working on this option because it's just we are doing it for test. So after you have MetaMask installed, you need to have some Ether in it. So if you don't have in it, you have to go to the buy section. If you have your Ether in your Binance or in anywhere else, you can go to view account and get your address here. And
okay,
you deposit your Ether to this address. Okay, then you would have your Ether here. So let's say we want to create a pool right now. Before creating a pool, we need to, as we talk about it, we need to have equal amount of assets, equal value. As in amount, I mean equal value of assets. So first I want to do a swap, which is a normal trade. I want to get some DAI. So if I sell all my Ether, it's gonna be around 3,000 something. So let's say I just want 1,000. So I'm gonna sell 1.94 Ether for 1,000 DAI. Okay, so you have to confirm it using MetaMask. Okay, transaction is submitted. We are waiting for a trade to happen. that's how you do a normal trade in Uniswap. So if you're just a trader, you can use this interface as well. So
basically, Uniswap is actually connected to the MetaMask wallet, right?
yeah,
It's
correct.
a wallet connected.
It's a gateway to Ethereum, decentralized apps, basically. So as we can see, it's done right now. So if I go to my wallet, I should see my DAI. Okay, I have 1,000 DAI and I have 5 Ether. So let's go to the pool section. Okay, that's the place that I want to create my liquidity pool. So we wanted to create equal amount. So okay, so let me first pick DAI. Okay, so I have 1,000 DAI, and it's automatically adjusting the amount that I need to provide for Ether. So if I change this, but let's say I just want to provide 1 Ether, I have to provide 515 DAI, which is pegged to US dollars. So basically you can think of it as $550. But let's say we want to go back to 1,000. So we have this amount of ETH that we need to provide. And I click supply. So I have to confirm it. Again, we should go to MetaMask and confirm the trade. Okay, so we can see that it's pending here, but the process is done. And okay, I think we can see that it's confirmed. So we have to be able to see the success inside the app as well. Okay, so congratulations, we made our first LP. So if we go back to this section, here we have our liquidity pool, which is a DAI-ETH pair. So if I click on manage, I can see exactly how much I have money in this pool. And I can click in this place and to see the stats for my pool. So because I just created it, I didn't get any fees or anything. So yeah, in this place, we are not going to see anything much. But here, if you're actually working on mainnet and you provide it, and you let's say after 24 hours, you should be able to see how much fees you earned during this time and what's the statistic of your liquidity pool. And if you're not happy with it, or I don't know, you want to take out your money, put it somewhere else, you can go back to this page and remove it. So in this process, when you're removing it, you can decide how much you want to remove. You can remove all of it, which you need to first approve.
Yeah.
Which is basically, yeah, a signature, and now you're ready to remove it, which is another transaction.
Yeah, if you've tried it for a couple times, it will come naturally to you, right? It's not that complicated, actually. It's quite simple to do that, to provide liquidity. So yeah, interesting.
Yes.
Yeah, it is actually. It's not a very, say, difficult process. But now that we are here, I think we can also take a look at this website. I think it's very interesting. So this is a place that people are doing yield farming. So it's basically the hedge fund that we talked about before. And so if you go to their FAQ, you can understand how it exactly works.
Mm.
So it's like the backstory is that they're just uh, let me see, where is it? So it's like these people here, as you can see, it's like they just wanted to pool together to avoid high costs on the fees. Because if I want to do yield farming by myself and I have only, let's say, $500, uh, it's gonna I have to pay a lot of fees, like gas fees on Ethereum to communicate with these contracts. And also I have to do a lot of research to find which one is the most profitable. So that's the problem they were solving. And it's one of those that is getting a lot of traction these days. So they have they're basically, they take your money, they farm with it, and they just pay 70% of it all to the people, to you basically, that's provide the liquidity for them. And they take the other 30%, and it's the other 30% is going for their stakers for the long term benefits of their users who hold their native token, which is farm.
Yeah, interesting. All right.
Yeah, that's also very interesting. It's
Yeah.
a very interesting project in this space.
So if I can share a bit, um, can I share my screen?
Yeah, sure. I have to stop, I guess.
All right. Can you guys see it? Yeah. So
Yeah.
basically, Binance Launchpool just come up with a new farming or a new pool. We just announced that you can now stake for PSG token and Juventus token. It's basically utility token on Chile's blockchain. So yeah, it's quite interesting. So if you want to stake, you can start from now until the next 1 month, and you will get rewards in forms of PSG and Juve token. And yeah, I think that's basically it. Just want to share that a little bit.
All right. I remember there was a DeFi staking section in Binance as well. Is it still there?
Yeah, it's the Binance Launch Pool. Basically, it works similarly with the
Yeah,
other. Yeah.
yeah, I think it's working with Compound, if I'm not mistaken, right?
I don't know. I don't remember to be honest.
Yeah, I think it's also interesting. There is a DeFi staking in Binance as well. It's providing direct access to these contracts
Hmm. Yeah.
for the
All right.
users. Yeah.
That's good. So Anderson, do you want to wrap this up? You're muted.
Okay, sorry.
Yeah.
So just to sum it up, right? That's what our guest Korea has been mentioning about this DeFi. Well, DeFi, as to compare with the CeFi now, of course, DeFi is something that is very interesting. It's a future actually. Inside Binance, actually, we can also have this kind of staking. There are things which actually work similar, and you can actually buy some coins like those related to the DeFi in Binance itself. But of course, whatever investment that you all do, you have to study first because, as Puria mentioned, actually there are risks involved in all these things. And the higher the profit that you can earn, the higher the risk it is. So thanks again to Puria for all the explanation. Really appreciate your time for tonight. Yeah. Anything else from Jackie?
Nope, all good. So yeah, just thanks to Priya for being here tonight with us.
Yeah, thank you
Uh,
very much for having me.
Okay. Okay. So that's the end of our session for tonight. If there's any question that anybody has, can just post in the Telegram Binance Malaysia group. I also saw from the YouTube there are some question here, and we can have Puria to reply for those questions. Okay. Thanks a lot again for everyone watching tonight. This is the end for our session tonight. Okay. Bye-bye.
yeah, see you later. Yep. Thanks, guys.
Thank you.
Okay. Good night. Yeah.